Well, today on the Accounting for You podcast, we have Aaron Smith, a commercial lender with People's Bank, where we're going to talk today about what you need to do to make your business ready to get credit from a bank, and maybe even talk a little bit about some SBA and other government-backed loans. Welcome to the Accounting for You podcast, brought to you by the accounting firm of Adkins and Reynolds CPAs. This podcast is designed to provide relevant tax and accounting information to help you and your business succeed. If you enjoy listening in, please like and subscribe to our channel. Now, on to the show. Well, welcome back to the Accounting for You podcast. I am Chris Reynolds, CPA and partner with Adkins and Reynolds CPAs.
And I am Jay Adkins, partner and CPA with Adkins and Reynolds CPAs.
Well, as we mentioned a little earlier there in the intro, we have Aaron Smith. He's a commercial lender with People's Bank. And we're going to talk today with Aaron about how to make your business ready to get credit from a bank, maybe what you need to do with your financial statements, and how the commercial banker or lender can actually work with us, the accountant, to make sure you're ready to get that loan and pay back that loan. So, Aaron, it's great to have you on the show.
Hey, thanks, guys. Thanks for having me on. It's an honor to be here today and love the podcast. It's great.
Great. We love fans, right?
We do.
Well, Aaron, tell our listeners a little bit about you and what you do.
Sure. So, Aaron Smith with People's Bank, commercial lender. Been with People's Bank for 7.5 years now. Started my banking career in 2004, late 2004. Spent the first 12 years of my career at J.P. Morgan Chase, the biggest bank in the country. Mm-hmm. We were all aware. And opted 7.5 years ago to make a change to community bank, and it's been great. My role as a commercial lender is really a client-facing role. Somebody asked, where's your office located? I said, well, it's in the silver car that I drive every day. So I could be anywhere. You could find me one day in Southeast Ohio and the next day in Pikeville, Kentucky, and the following day in Morgantown, West Virginia. It doesn't matter. We go where our clients are. So really my job or my role is as a commercial banker is really client-facing. You're not going to see us in our office an awful lot. We like to spend time in front of our clients. That's how we get to know our clients. It's also how we get to know and understand their businesses. A lot of times you'll find lenders that are what I call industry generalists, or we find people that are specialists. And I think the more you call on clients, the more of a specialist you become. So really my role is I'm not out there on the streets looking for transactional business, though we do some of that business. My job is really to become a trusted advisor. My goal is if you ask many businesses who your CPA or who your attorney is, my goal is to be that name that they mention at the table as well. Because I think it's vitally important, not only in my role, but the role that you all have, you guys as CPAs have with that business. And I think it's vitally important for the commercial banker and the CPA to work together. That's how we achieve the goals of what the client goal is in goal.
Yeah, obviously it's a two-way street there with a CPA and banker. Without good bookkeeping practices, without financial statements, you can't really make loans.
Absolutely.
So if I'm a small business owner, what are you as the banker, the commercial lender here? What are you really looking for?
So I think there are three things that vitally come down when we look at you approach me, a customer approaches me, or the borrower, or the relationship, a business owner approaches me. One is, what does the business do? We got to understand the business. I can't just take a financial statement. I could take a financial statement and say all kinds of things, but what does the business do? What is the need for the loan? A lot of people go, well, it's none of your business. And I say, well, you don't need a loan then. So it is vitally important we understand what the need is. And the more I know about the business and the better relationship I have, the easier it is. But three things that I think we look for that are vitally important, I mentioned this a lot, is, in 2008, 2009, banking changed forever. Dodd-Frank changed a lot of laws. I had a lot of friends that were in banking prior to this, and if you had piece of real estate, piece of equipment, we'll lend on it. Didn't matter if your business made money, didn't matter if you had the capacity to repay that, we'd lend on it. 2008, 2009 changed that forever. And I have to remind people that as of today, that when you come to the bank to look for a loan, we're looking at cash flow. How much capacity does the business have to be for debt to be able to repay that on an annual basis? So cash flow is one of those. Collateral, obviously, we have to be secured in our position. And then what we call capacity. Capacity would be the individual themselves from a personal financial state. What do they have the ability in case the business fails to be able to repay this debt to the bank in case the business fails? And you hope that never happens, but unfortunately, we have to look at all those aspects. So cash flow, collateral, and capacity are three things that I think are vitally important when we're looking at an application.
Okay. So what I heard in that, cash flow obviously is very important, because if you have a business that is not doing well or failing, I've had clients, if they have a failing business, they'll be looking into going, well, I need to go get a loan because I can't make it. So if we're showing losses every year and I want to come get a loan, but I'm assuming you're looking at how can I even repay the loan, right?
So you make a great point there, and I'll speak to that. So a lot of times we do have businesses that all of a sudden, man, I need to borrow money. My line of credit's maxed. I don't have any money. And, one of the things we find is when you start to take a look at the financial statement, again, this is why it's vitally important to work with a CPA and a business to work with a CPA. And even a small business, work with a CPA that's got managed bookkeeping. So the CPA is laying eyes on it, not just some run-of-the-mill bookkeeper. Because a lot of times what we'll see is that when we get into the financial statement, what the business is actually looking for is a line of credit to fund losses because they're not making money in their business, but they don't know that.
Right.
Because they don't have anybody that's sitting down with them to review the business, to look at the financial statement and say, hey, you don't have to take every job on, because actually the last 5 jobs you've taken on, you've lost money, which is why you're coming to the bank needing to borrow money to finance losses.
And certainly a loan for a failing business is not the answer and not the cure.
Absolutely. And we see that. And then, of course, the customer gets mad at us.
Right.
And the reality of it is they should be mad at themselves and mad at whoever's been helping them along the way because they've not been getting the advice that they need.
Right.
So sometimes I have to be the big guy with broad shoulders to tell them no.
Just another reason that as we talk to clients, a lot of times it's vitally important for each business owner to understand their business, understand what's happening in their business so they can make all the proper decisions.
Right. And that leads to another point that I want to talk about, especially the vital importance of financial statements and the partnering with, the commercial banker and the CPA is, a lot of times when we're meeting with clients, not every business needs to buy something every year. But there are businesses that do need to buy things. The larger your company gets, especially if you're in the service industry, maybe the manufacturing industry, there are times that your equipment that you have has a shelf life.
Right.
Okay. And there are opportunities that, at some point in time, maybe that's 3 years, 5 years, 10 years, that equipment's going to have to be replaced. The problem we find is people don't think those things through. They're not talking about those things. So then a piece of equipment fails. They're not working with a CPA or a good bookkeeper. And they come in and I look at their financial statement. In the last 3 years, they've lost money every year. Because somebody told them, well, you need to go buy this, or you need to do this, or you need to distribute the profits out of the company, and you show a loss every year. That's a problem. Because the question then becomes is, do you want your business to be able to grow, or do you want your business to stay or maintain where it is or close? So we get to that point where I like to call it, do you want to be a bankable client, customer, or an unbankable client or customer? So those conversations sometimes have to happen with me or us at the bank because they're not working with a trusted professional.
Right. And if you're working with a CPA, working with us and on financial statements or our managed bookkeeping services, then that's kind of stuff that we're looking into, and we're going to be talking to you obviously about your financials. But if you're going to get a loan, we can kind of maybe pre-vet you a little bit and look at your financial statements and talk to you and go, hey, these are not that good. You may not be able to get a bank loan. Or the other topic that you brought up is you don't need to buy something every year.
Right.
And I've had other clients, when they come to us as a new client, they say, well, my former accountant used to tell me to buy something, they told me, or they went and said, you need to buy something this year. And my question always is, well, did you really need that? Because, you're spending $1 to save 30 cents on your tax bill. There's other ramifications with banking on that. Do you even need the asset? You can go broke fast that way. We have, I think, our episode number 2, I think, talks in depth about that. That's very important to think about.
One point I want to make too, and then this is, I see this a lot with smaller businesses, and you talk about we need to buy something. Mm-hmm. One of the most common things we see in the banking industry, and I don't know where this advice comes from the client. I don't see it when they're working with a CPA regularly. I think I see it when they've worked with some of the fly-by-night big box, H&R Blocks or whatever, which I know you guys love very well. So, one thing I see is they come into the office and they say, my line of credit is maxed. Mm-hmm. Now, we just talked about that a minute ago. But when I start asking questions, I find out that somebody gave them a line of credit and they've went and bought equipment on that line of credit.
Right.
So now, when did you buy that equipment? Well, I don't know, 2-3 years ago. So now you've got a depreciable asset that you've been paying interest on for over 2 years with no ability, and you've made no principal payments to it. Well, that's what my bookkeeper told me to go do. Well, I think you need to let me introduce you to someone else, because the problem is, I think you guys know, that's working capital. That's not. I mean, you've now taken an asset and put it into your working capital. So how do you pay your employees? How do you pay your contracts or your services in between the time you're being paid? Well, they just told me to go just use my line to buy equipment.
And when we're doing tax planning at the end of the year, we see that a lot, that people will have the theory, I need to buy something. And I think there's a lot of being so adverse to paying taxes that they will do economic harm to their business.
I would agree.
Chasing a tax break that maybe they don't need in that year, that's maybe better for a different year.
I agree.
Yeah. Yeah, so obviously financial statement preparation is important. So if I've got good financial records and I take my financial statement to the bank to meet with you to get a loan, I'll probably end up bring a copy of a tax return and all that. And we get the loan and we start making payments. Let's talk a little bit about the after the fact. I've got the loan, I'm making payments. Are there requirements, covenants that we have to meet?
Yeah, that's great.
Because I think a lot of people think, well, I've got the loan, all I got to do is make my payment, and then the bank sends them a letter and goes, oh, by the way, you need to prepare or provide something else.
Yeah, that's a great question, Chris, because we do see this all the time, and I think this is a great part of why it is vitally important for the CPA and the commercial banker to work together. Because when the bank approves a loan, we're going to install what we call loan covenants. That could be a cash flow covenant. That could be a leverage covenant, debt tangible net worth. I mean, there are going to be covenants that we put in place. That way, the business retains cash. It retains its financial stance. And it doesn't, we're not saying we can't allow the business owner to distribute money out. Mm-hmm. We're just saying, hey, look, we don't want you to distribute all the money out. You can distribute the money out down to a 125 debt service coverage, which is a standard covenant that you're going to see in many loan documents. I'm not going to jump into the weeds. There's a lot of other covenants we will put in place depending on the industry and type of company. But it is vitally important, because what a lot of times we'll get is we'll put that information in, we'll try to reach out to the CPA, or, they'll get the loan and we'll say, I'll send the docs to the CPA. And I'm like, no, I'd like to really talk to them so they understand. And the next thing I know, we get to the end of the year, I get the financial statement. And I already know, because I look at it and I said, you didn't take this to your CPA and talk to him and share these loan covenants, did you?
Potential problems that I could see there, again, if it's a financial statement prepared by a client that's not familiar with things, they may make it appear on their financial statement that they have violated their loan covenant when really they haven't. And it's because their financial statements are not cleaned up. They may be coding accrued expenses to the income statement instead of removing them from the balance sheet. And they're showing that they owe a lot more money than they really do, and they may be out of covenant, where if they talked with their CPA and cleaned up their financials, everything's fine, and the banker is not going to redo the financial statement.
No. But one benefit of working with a commercial lender like Aaron, I do know for a fact, he knows how to read financial statements,
right,
and probably could head off that topic, because
yes,
he does know how to read a financial statement, where I think a lot of commercial bankers just throw them in a file and go, geez, thanks, we'll send it to underwriting.
Right. And that was something that was shared with me a long time ago. One of my mentors said, listen, you never send a financial statement to credit underwriting until you've reviewed it yourself. Mm-hmm. And it's right, because you should be able to read. If we're going to be a trusted partner, trusted advisor, I should be able to read that financial statement. And another point to this is, in my role, I am meeting with that client at least once a quarter. Okay. And if you have a loan with us, we're likely getting quarterly financial statements. Mm-hmm. And I can take that financial statement and very quickly calculate whether or not you're going to be in a loan covenant, and start to head off those questions before we ever get to the end of the year, and say, hey, did you forget to let your CPA know that you have these loan covenants? Because I'm looking down here and I see you've taken money out of the company. And why have we taken money out of the company? There's a personal need that's a one-off expense? What are these things? I need answers.
Yeah, and just to kind of roll back a little bit about to explain maybe a layman's term of what loan covenants are, what we're talking about. You agreed to get the bank loan, but then the bank also puts upon you other rules. In addition to making your loan payments, you also have other rules to follow to make sure that your financial statements look a certain way or have certain key ratios met.
Correct.
To make sure your business is financially stable, in their opinion, to make sure that you can continue making their payments. And then if a business gets out of agreement with the loan covenants, what happens there normally? I mean, I'm sure that's a broad, real big ball of wax there, but just a generic.
Yeah. So I think everybody thinks the worst at the very beginning. If I haven't met a financial covenant or a loan covenant, what's the bank? Are they going to call my note? Are they going to foreclose? The answer to that is no, not right off. I mean, they're going to, the bank and the banker is going to work to try to get those back in line with one another, whatever those, covenants are that we've put in place. Mm-hmm. If we cannot find a solution to get you back into in compliance, then a lot of times you're going to meet an individual within our group called Special Assets. And those folks are going to work with you, and they're not very nice people. I'm just going to say they're not very nice people.
You don't want to have to talk to that guy.
You do not want to have to talk to that group. But their job is at that point to protect the bank. The bank has money lent out. They have, risk, and they're going to try to mitigate that risk as much as they can during that period. So the idea is as a banker, as a customer, as the CPAs, our job is to make sure that it never gets there. And that's a very small percentage of times that ever gets there. But I will say it does happen. Mm-hmm. And if the times that we're kind of in right now, interest rates start to rise, loans come back for renewal. They're going to renew from a 4% interest rate to a 6 or 7% interest rate. Mm-hmm. Things changed since then. So you've got to be diligent. You got to start, securing cash, I guess, kind of keeping your cash, holding your cash in the event that those interest rates begin to rise and you have to renew something at something higher, that you have the capacity to be able to repay that.
And you mentioned looking at someone maybe taking too much in distributions.
Yep.
In our tax planning, obviously, we use different things. One being the Section 179 to expense equipment.
Yep.
That really helps in tax planning. Maybe talk a little bit about how you would look differently at an owner who is expanding and may buy $1 million of equipment, and we write that off, versus an owner who may be taking $1 million of distributions that's disappearing from the company.
Right. Yeah. So there's a big difference there, Jay. That's a great question. And, I'll lead into my answer with this is, in my role, we have companies that are, service-oriented companies that whether you're small or, maybe you're 50,000 in revenue, 100,000 in revenue, you're $200 million in revenue. You're going to have equipment that fails. You're going to have equipment that, as I mentioned before, that are going to have to be replaced. Our job is we sit down with a lot of our clients and say, tell me, what are you planning to buy this year? What needs to be replaced and what's the plan? So we'll actually sit down with a client and put in place a, capital expenditure equipment facility. And it allows them at the time that the equipment's needed, they can go purchase it and they're not having to worry that the equipment failed, come back to the bank. But to answer your question it's very different. If you're taking, Section 179 depreciation, when we're looking in a financial statement at the end of the year, whatever that depreciation is, we're adding back into cash flow. So way different than a distribution, because with a distribution, it left the company, it's not coming back.
Right.
It's not there, so I can't add it back. So it negatively affects the impact of, when we're taking a holistic approach looking at the financial statement, it is detrimental to the financial statement if you're taking $1 million of distribution versus $1 million of Section 179 depreciation.
Yeah, we did. Yeah, those big distributions to owners, I'm sure scares.
I will call that
scares the banker.
I will call that client and inform them that they are now an unbankable client versus a bankable client.
Also scares the CPA in a lot of
that's true. That's true. That's true. So you talked a little bit about the tightening credit market that we're in. I think Jay we were talking earlier about, the banks that had failed, and what were you want to set that one up, Jay?
Yeah, I was just thinking that, we've heard in the news that, there were a small number of bank failures in the spring. Heard a lot about credit getting tighter, and now I hear maybe it's not as bad, right. And, how that's affecting everything. And then we also, hear from clients, there are some banks out there that failed. Are my deposits safe?
Yeah,
there's some concerns there.
That's a great concern. And the one thing I want to say is, don't allow the media to scare you. The media doesn't sell good news. Good news doesn't sell. Only bad news sells, and they want to scare you. So one thing I want to and it's a great segue, because the one thing I would tell you is do your homework. Go and look at the banks that failed. Look at your current banks. The other thing I want to mention too is not every bank is a part of this, but if you have a lot of money in a bank, over $250,000, and you're concerned about it, talk to your bank about ICS. I don't want to jump into the weeds too far, but basically ICS is a form of insurance where People's Bank can go out to another bank and rent their FDIC insurance. Okay, so let's just say you have $20 million in my bank at People's Bank. We can fully insure that money on deposit through ICS. Not every bank does this, but there are many that do. And we've been able to provide some comfort for a lot of our depositors because of that. Because there's a lot of money. I think I saw something the other day that the U.S. government pumped 40% more money in the economy than they ever have in history. So a lot of people are still sitting on a lot of cash, and they want to preserve it, and they want to make sure it's safe. And a lot of people don't want to put that in the stock market. Mm-hmm. So I think you just need to be reasonable, do your homework, and read, and not be taken off by what the media is putting out there for you to
And I would
digest.
certainly suggest for any clients that are in that situation, think about working with someone like Aaron and the ICS versus trying to take all your money and go to how many ever different banks and spread out $250,000 a piece. That's a lot of work, a lot of effort. I've seen clients before that lose track of the interest rate they're getting.
Right.
They parked money somewhere, forgotten about it.
Right.
They're locked into some small interest rate with a rising interest rate now. They're not really getting what they could.
Yeah. It is. And I couldn't imagine having to go to like 7 different banks and put money in 7 different places and try to keep track of 7 different accounts and hope that that bank is okay and that they don't have problems. And, the worst thing would be is that, you get bank C down there where I put my money failed and I forgot my money was there, and now all of a sudden, I'm going to go get my $250,000 back, and not for this topic of conversation. Mm-hmm. I think you should read what the FDIC insurance policy says. You just don't show up and get a full check back for your $250,000.
Right. Yeah. Probably best not to get to that situation.
And I think part 2, Jay, what you were asking about is interest rates and how they affect. I mean, as interest rates begin to rise, there's a natural tightening that begins to happen. It's not as bad as what people think it is out there. I think we had a one-off conversation earlier. We were kind of talking about, what do you see your clients beginning to pull back, not thinking about moving forward. We've not seen that. We see clients continue to move forward, borrowing money as needed when projects come up. And it's kind of surprising because we're now in interest rate ranges where 2008, 2009, and even up into 2017, 2018, when people were pulling back from borrowing money because the interest rates were higher, we don't see that today. And it may be because they do have a fair amount of cash on deposit.
Yes, I think so.
Yeah. So, we've kind of talked about, with that, but kind of touch on some previous topics here. We were talking, it sounded like, you as the commercial lender, you want to be a trusted advisor. You want to be in working with the CPA, maybe a financial planner for the business, whatever that may be for that business. It sounds like you're trying to be or want to be very relational to the client, and that's because you want to know and understand and really get into to help that client. Well, so if you're interested in working, obviously, with our accounting firm, you can reach out to us. We have all of our contact information in our show notes. Aaron, if people are wanting to work with you directly, how would somebody get a hold of you?
Yeah, so they can reach out to me. I believe we're going to put the information in the show notes here. Mm-hmm. They can reach out to me, and my phone number, my email. I am on the road. I will also provide my cell phone number. Would love to sit down and talk with you and see if we're able to even help you. For me, it's all about a relationship and not a transaction. So want to come out, want to understand the business, and also want to understand and see how you operate your business as well.
Yeah, sounds great. Yeah, so all that information will be down in the show notes. How to get a hold of Jay or myself or Aaron. We all be very willing to work with you and to talk to you and to see what we can do to help you. So if we don't have anything else, I think that's pretty well as a wrap on this episode. I'm talking of commercial lending and stuff. We appreciate Aaron coming in. Until then, we will see you on the next Accounting for You podcast. Thank you for taking time today to listen to our podcast. We appreciate listeners like you and ask that if you enjoy what you hear, please like and subscribe to our channel to ensure you receive the latest episodes as soon as they come out. If you have any questions about the topic we discussed today or would like more information on becoming a client, please do not hesitate to contact our office by visiting arcpas.com or theaccountingpodcast.com.